Hi, I'm Richard Hutton and welcome to the Exponential Fund, the place where you learn to invest and absolutely crush average market returns. Today, I go deeper into my philosophy and tell you why I believe it is almost impossible to correctly value a high-growth tech stock. Now, here's what I mean by this. You can almost divide the world of finance into the old world and new world. Like before the computer and the internet, before the age of the exponential. Before, companies would be valued usually on a multiple of their profits. So if last year they made $1 billion in profit, the company should be valued at like 10, 15 times that. Something. It was fairly simple because the future wasn't that different from the past. They were growing at 6% per year. It's easy. But now, it is completely different. Companies like Amazon, Tesla, for almost 20 years, they are losing money each year. And for an old school investor, this would make no sense. How could you invest in a company that's losing money? What kind of company is that? A fast growth tech stock. So the reason why these companies are losing money for such a long period of time is because they understand the value of scale. They need to scale up as soon as possible, reach market dominance, and then optimize for cost. Because if they don't do it, if they take it slow and remain profitable, someone else, a competitor, might invest more aggressively and just capture more of the market and you're fucking done, right? Amazon was one of the first to do this and now it's common practice. So really, the job of the CEO was to sell investors the and how much they bought into it depended on how much they bid up the price of the stock, and thus they had access to capital very easily to invest enormously in long-term, far-off projects. Thus, these days you value a company based on its future earning potential. Here's the problem. Because these companies grow so fast, 20%, 30%, 40%, 60% a year. How do you project forward? How long do you project into the future? 2 years, 3, 5, 10, 20? Based on that, your valuation estimate could vary enormously because of the sensitive dependence on initial conditions, right? So with Tesla, it's my favorite investment, my biggest investment. This is not advice, but I'm just saying. Tesla said publicly, we aim to grow at around 50% per year for the next 10 years. Okay? And I've heard analysts from prestigious firms say, well, we're going to be a bit conservative. We assume 30%, 35% growth. That's a huge fucking difference. 50% versus 35%, especially 10 years out. You get a completely different estimate. How do you even assign a probability? Okay, the company says they want to grow at 50%. What's the chance they'll succeed? Well, you can look at the history track record, but still, a small change leads to a hugely different result because of this steep exponential. Then, simply you look at the time horizon, right? So if the company says, we aim to grow this fast for 10 years, and you only plot out the next 3 years or 5 years, you get a completely different result than if you were to project out 10 years. And where does this arbitrary timeline even come from? Again, we gotta go into the deep end. We have the neocortex, and we think we're so fucking clever with our intellectual calculations. And yet, we still have the amygdala, the reptilian brain, which hasn't disappeared, is still there and fucking whispering, and especially in crisis situations or in extreme situations. Your judgment can get clouded. An investor ideally would want to see nice and steady growth, as little volatility as possible, preferably 1% per month, every month, instead of sometimes 50% per year, sometimes minus 20% per year, sometimes plus 10, plus 11. Generally, investors want a smooth growth. Now, why is that? Because volatility, it's almost like a crisis situation and triggers that reptilian brain. If you put your hard-earned money into an investment and 3 months later it dropped 40%, Jesus fucking Christ, you feel like your existence is in danger. Even though there's nothing wrong with the investment, it's just, normal market cyclicality. Thus, investors think in quite short time periods, like quarterly. They obsess about the next quarterly report, the 12-month target, and shit like that. In the world of investing, that's a joke. That's a millisecond. That's fucking nothing. What matters is the long-term trajectory. This is actually a huge edge you can have. Simply have the longest time frame. Because if you think in a 10-year time frame and everybody else is thinking in 3-year time horizons, 10 years will pass for both of you, right? But the way you think about it is very different. So, about valuing a high growth tech stock. Not only is it so hard to predict the sales growth, but with these great tech companies, they achieve operational leverage, where the sales are growing faster than expenses. Just Tesla last quarter increased sales something like 90%, and costs only grew 60%, about, right? How can you possibly predict that? And that gap is very important, right? Because eventually, you're not just calculating the value of the company on a multiples of their sales, but profits. How profitable will they be? If today they're making 10% margin, 10 years from now, will they be making 20% margin, 40%, 80%? No idea. And that changes the valuation drastically. Also, simply the multiple that you give them. So, okay, if they earn today $1 billion, how much is the company worth? I don't know, like 20 times more, 20 billion, something like that. But the multiple depends on the outlook. When 10 years have passed, you will have a rough idea of what they will do 5 years from then. So if you see the next 5 years as, stagnating growth, they will receive a smaller multiple compared to if they had a bunch of new inventions on the way, and actually they can still grow fast for a long, long time. So the multiple can vary significantly. Instead of 20 times profits, they may be 60 times profits. So you're 3 times off from your estimate. There are so many freaking variables with these high growth tech stocks. Practically, it's impossible. It's impossible to estimate. And you know what? I don't try to. When I set my intention that I want to grow my account for as long as possible, I thought, okay, what is possible? I don't want to limit myself and just say a large number, like until I reach 100 billion, whatever. Why that? Is it not possible to do more? Let the market dictate what is possible. If you had 200 billion, you couldn't invest and beat the market? Of course you can. Like, there are trillion-dollar companies who grow very fast, like Amazon, Google, Microsoft. So it's absolutely possible. I said, okay, I looked at Warren Buffett and understand, okay, he's the best in the world. He achieved the greatest performance ever. But does he represent the limit of human potential when it comes to investing? Absolutely not. Is there room to improve in his approach? Of course. It would be ridiculous to think otherwise, that what he's done is perfect. No, there's room for improvement. Rules that have worked in the past may not work, may have to be modified. So he says, basically, invest in wonderful businesses at an attractive price. Attractive price meaning not overvalued. But if in this new world, it's almost impossible to value a company, how are you supposed to apply the rule? I say, fuck that. I say, just my opinion, invest a small sum in a bunch of these large, fast-growing companies, and the solution to the valuation problem is rebalancing. So if you put 5% into Facebook, 5% into Tesla, let's say a month passes, Facebook goes up a bunch, Tesla goes down some. Now Facebook is not 5% of your portfolio anymore, but more, maybe it's 6%. So you sell some Facebook to get it back down to 5%. And with that money, you buy Tesla to get it up to 5%, right? Because if Tesla dropped, and it's less than 5%, maybe it's 4.5%, whatever. So you buy Tesla. And what do you accomplish with this? You buy more of a stock when it's down, and then you sell some when it's up. You counteract the possible case of an overvalued company. If I actually invest in, I don't know, Zoom, which were selling at like 50 times sales, not profits. The business was valued at 50 times more than the entire sales of last year. That's pretty fucking insane. Is that overvalued? I don't know. I say maybe I have the naivety or the ignorance to say, I don't know if that's overvalued. But if it is actually overvalued, well, it will correct, right? It will drop. Great. What will I do? I'll fucking buy more. And then when it goes up, I'll earn even more. So I even out that possible risk of an overvaluation, right? And with the new update to the strategy, I only invest in companies that have recently dropped, which increases the chance that it's not overvalued, right? If it's down 30, 40, 50%. So, in short, that's it. I say, with humility, I have no idea if this company is overvalued. I look at sales growth. Is it still growing fast? Great. I'll keep my money invested. Oh, it's not growing fast anymore. Fuck it. I'm selling. Let's see if this works in the long term. Until next time.